Welcome back to Griffonomics. Usually when we open up a corporate file, we're looking at a strategy that's pretty much fully formed.
Right, that's all laid out.
But today, we are looking at a company that feels more like a triage unit in a hospital. It is Thursday, February 5th, 2026, and we are doing a deep dive into the granular, messy, and frankly high-stakes transformation of Crown Castle.
Triage is the perfect word for it. It really is. You have a patient, in this case, one of the biggest real estate investment trusts in America, that's trying to do major reconstructive surgery.
While having a heart attack at the same time.
Exactly. A massive cardiac event right in the middle of the operation.
That is a vivid image, but the data completely backs it up. We're looking at Crown Castle's Q4 2025 earnings, which just dropped. We've got the transcripts and some very sharp notes from Barclays.
Skeptical is putting it mildly.
It is. So our mission today is to answer one big question. Is this new strategy, what they're calling Crown 2.0, a masterstroke of focus, or are they just shrinking themselves into irrelevance?
It's the multi-billion-dollar question.
Yeah.
And to answer it, you have to juggle three huge moving parts. You've got an $8.5 billion asset sale.
A massive lawsuit against a customer who just defaulted.
And a complete 180 on how they plan to spend all that cash.
Okay, let's start with the context. For a long, long time, Crown Castle was sort of the everything store for U.S. telecom infrastructure. You needed a big steel tower. They had 40,000 of them. You needed fiber optic cable. They had it. Small cells on lampposts. Them, too. They were the diversified player.
And that was the pitch to Wall Street for a decade, right? We own the entire ecosystem. But the reality, which has become painfully clear, is that not all infrastructure is created equal.
Right. The economics are just totally different.
The economics of a giant steel tower in a field are radically different from fiber cables you have to bury under a sidewalk.
And that's the first key insight we need to lock in. The tower business is passive. You build it once, the carriers hang their gear, and you
collect rent for 30, 40 years with very little to do. The margins are enormous. It's basically a toll booth in the sky.
A cash machine.
It is. But the fiber and small cell business, that is active, messy, and it is so capital intensive. You're constantly digging up streets, dealing with permits.
Fixing breaks, upgrading things. It just burns cash.
It does.
Yeah.
So Crown 2.0 is basically an admission that the whole everything store model, well, it failed.
So they're stripping the house down to the studs. They are selling that entire fiber and small cell business. I mean, we're talking about a portfolio of 90,000 miles of fiber and 105,000 small cells.
All of it. They're exiting the messy stuff to become a pure-play tower operator.
And the price tag for that exit.
It's significant. They have an agreement to sell it for $8.5 billion.
Yeah.
And the update we got yesterday confirms that deal is rock solid.
And it's moving faster than people thought, right?
It is. They've already cleared the Department of Justice review, which is, usually the biggest antitrust hurdle.
Yeah, that can take forever.
That closed with no action. Now they're just waiting on a handful of state approvals. They expect to close this in the first half of 2026, probably by June.
So on paper, this should be a victory lap. They're dumping the low-margin business, getting a truckload of cash, and they're going to look a lot more like their main rival, American Tower.
And the market loves American Tower.
Because they are pure steel.
That was the plan. The whole theory was become a pure-play tower company, and the stock market will reward you with a higher multiple.
Let's just quickly define multiple for everyone, just so we're on the same page. It's essentially the premium investors are willing to pay for every dollar of earnings.
Right. Investors pay a premium for safety and simplicity. Pure tower companies trade at a higher price relative to their earnings because their cash flow is just so predictable. Crown wanted that premium. They wanted to be boring and profitable.
But, and here's the twist, you can't just sell half your business and expect the other half to run itself. You have to restructure the human side of things too. And what they announced looks like a bloodletting.
Oh, it is deep. To fit this new, leaner model, they're cutting their remaining tower and corporate workforce by 20%.
Wait, 20% of people who are supposed to stay?
Yes. Remember, about 60% of their total workforce is transferring over to the buyer of the fiber business. But of the people left behind to run the towers, another 20% are being let go. Crown Castle is going to end up with only about 1,250 full-time employees.
Let that sink in. This is an S&P 500 company. They own 40,000 towers across the entire United States, and the whole thing is going to be run by 1,250 people.
It is startlingly lean. They claim this is going to save them about $65 million a year in SG&A, your basic corporate overhead.
They must be banking on tech to fill the gaps.
Heavily. They're talking a lot about digitization and AI to automate the things that, human administrators used to do.
I feel like every company in 2026 says AI will fix it, but in the tower business. Is that actually realistic?
It's more plausible here than in some other industries. I mean, if you have good software managing lease renewals, maintenance tickets, billing, you really don't need a huge army of people in an office. The goal is just to be the lowest cost operator.
Okay, so that's the blueprint. Sell the fiber, cut the staff, run the towers, count the money. Sounds great on a spreadsheet. But then we have to talk about the elephant in the room. Or maybe the elephant that just walked out of the room without paying its bill. Enter Dish Wireless.
The Dish crisis. This is the variable that just wrecked the entire model. This is the heart attack we talked about.
Dish was their fourth largest customer. We're talking about 5% of Crown's total revenue. And in January, just last month, they defaulted. They just stopped paying the rent.
And Crown's reaction was fascinating. Usually in this business, if a big tenant stumbles, you try to work it out. You restructure the lease, you give them a payment plan.
You try to keep them.
You do. But Crown didn't do that. They went nuclear. They terminated the contract. Done. The CEO basically said, if you aren't paying, you aren't staying. They cut the contract, and now they are suing Deleveraging for the net present value of the entire agreement.
Net present value sounds technical, but it's basically Crown saying, you signed a contract for the next 10 years. We want all of that money right now.
Exactly. And the number is just eye-watering. They are suing for over $3.5 billion.
Okay, but this is where the investigative part comes in. Suing for $3.5 billion and actually collecting $3.5 billion. Those are two very different things.
Very different, especially when the company you're suing is, broke.
And Barclays pointed this out in a really biting note. They warned that collecting this money could be a nightmare because of financial engineering.
Which is usually just code for hiding the money, isn't it?
Pretty much. In this context, yeah. There's a fear that EchoStar Dish's parent company has already moved its most valuable assets, their spectrum licenses, into different subsidiaries.
Like a shell game.
It's a shell game. If Crown sues Entity A, but all the good stuff is sitting over in Entity B, Crown might win the lawsuit but walk away with just a piece of paper.
So they're holding a $3.5 billion IOU that might be worthless. And in the meantime, they have a massive hole in their budget for this year.
A $220 million hole, to be exact. That's the revenue they were counting on from Dish that just, poof, vanished.
That's what we call churn. And for a REIT, which lives and dies on steady cash flow, losing $220 million overnight is catastrophic. It wiped $280 million from their forward-looking guidance.
And this leads to a really strange dynamic I found. Crown is suing Dish, right, fighting them in court. But at the same time, Crown is basically acting like a cheerleader for Dish to sell its assets to someone else.
It's the bank shot strategy. It seems contradictory, but it's just pure pragmatism.
It's all about the spectrum, isn't it?
It's all about the spectrum. DSH owns a mountain of it. The government licenses to transmit data. But spectrum is useless if it just sits in a drawer.
Yeah.
You have to put equipment on towers to use it.
And Crown knows Dish can't afford to do that anymore.
Right. So Crown needs Dish to sell that spectrum to an AT&T or a Verizon or a T-Mobile.
Because they pay their bills.
Exactly. Because the big three are solvent. If AT&T buys that spectrum, they will need to lease space on Crown's towers to deploy it. So Crown is saying, Dish, we're suing you, but please sell your assets to a rich company so they can come rent space from us.
It's 4D chess. But while they wait, the financial reality for 2026 is completely different. And this is the part that I think really burned shareholders. This is the pivot from offense to defense.
This is the critical takeaway. This is where all the money went.
Right. Let's rewind. When Crown announced that $8.5 billion sale, the story was, we're going to get this cash and we're going to buy back our own stock.
Oh, investors were salivating. A huge share buyback reduces the number of shares out there, which almost always sends the stock price up. It was supposed to be a big payday.
But the Dish default killed that dream.
It did. Because when they lost that steady income from Dish, their credit metrics got worse. And for a REIT, credit ratings are everything. You borrow billions to build towers, and you pay it back with rent. If your rating drops, your interest rate goes up.
And your profits disappear?
Gone. They're currently rated investment grade, and they have to protect that rating at all costs. So instead of giving that cash to shareholders,
they're taking $7 billion of that $8.5 billion sale and just using it to pay off debt.
Correct. They're prioritizing the balance sheet over the shareholders. That $7 billion is just to keep their leverage ratio in a safe spot, around 6 to 6.5 times their earnings.
That is a staggering pivot. $7 billion just to get back to zero. So the shareholders get what?
Scraps. They have about $1 billion left for buybacks, which, for a company this size, is negligible. It's a token gesture.
And that explains why the stock dropped 7.1% after the announcement, even though they technically beat their earnings estimates for the quarter.
The market looks forward, not backward. The backward-looking numbers were fine. FFO was $1.12 versus estimates of 96 cents. But the forward-looking guidance had a $280 million hole in it.
And no buyback party to cushion the blow.
And on top of that, the dividend is frozen.
Frozen solid at $4.25 per share. Management was very clear. They will not raise that dividend until their payout ratio drops to about 75 or 80%.
And just to be clear, the payout ratio is the percentage of their earnings they give out as dividends. So with earnings taking a hit from Dish,
that ratio just got worse, not better.
Exactly. So they are further away from raising the dividend today than they were yesterday. For income investors, this is a huge red flag.
Okay, so let's recap the triage status. We have a frozen dividend, a canceled buyback, a massive lawsuit, and management is calling 2026 the trough.
Trough is just corporate speak for rock bottom, and they're telling us this is as bad as it gets.
They're guiding for organic growth of about 3.5% this year. Is that good? It sounds low.
In the glory days of the 5G expansion, we saw 5 or 6% growth. So 3.5 is modest, but, and here's the one silver lining, they noted that 80% of that growth is already contracted. It's locked in.
So it's boring, but it's safe.
That's the pitch. We are boring, safe, and we've cleared the decks. But for an investor to jump in now, they need a reason to believe things will accelerate after 2026.
What's the light at the end of the tunnel?
Well, the bull case really relies on two things. First, the big three carriers continuing to spend money. Second, the federal government.
Let's talk about the carriers. We keep hearing about peak capex, the idea that the big spending on 5G is over.
It's a half-truth. The frantic build 5G everywhere now phase is over. That gold rush is done, but networks get congested. You have to add density. You have to upgrade equipment.
So even if they aren't building brand new towers, they're climbing the existing ones to add better antennas. And every time they touch the tower,
Crown gets an amendment fee. Exactly.
Yeah.
It's steady grinding growth. But the real explosion, the thing that could push growth back to 5 or 6%, is the FCC.
The spectrum option.
The 2027 auction. The FCC plans to auction off another 800 megahertz of spectrum.
Okay, we keep coming back to spectrum. Let's use an analogy because megahertz makes people's eyes glaze over.
Think of spectrum like lanes on a highway. The carriers are the trucking companies. Right now they have a certain number of lanes to move our data, our TikToks, our Zoom calls. As we use more data, those lanes get jammed.
Traffic slows down.
Right. And the only way to fix it is to build more lanes. In the wireless world, you have to buy those lanes from the government. That's the auction. Once you buy them, you can't use them unless you put new radios on towers to broadcast on those frequencies.
So new lanes equals new equipment, which equals new rent checks for Crown Castle.
Precisely. That is the catalyst they're waiting for. They are basically just treading water in 2026, waiting for that 2027 auction to open the floodgates.
But they have to survive 2026 first. I noticed in their own spending, they're being incredibly stingy.
Discipline is the word they use. Starvation diet might be more accurate. They're only spending about $150 to $250 million. And they explicitly said, no speculative builds.
Meaning no field of dreams, no build it, and they will come.
Zero. Unless a carrier has signed a contract and guaranteed the rent, Crown isn't putting a shovel in the ground. They are in pure cash preservation mode.
So zooming out, we have a company that has, amputated a limb to save the body. They sold the fiber business to pay off the debt that was caused by the Dish disaster.
That's a fair assessment. They are cleaner, leaner, but they're also smaller.
The analysts seem pretty skeptical. The consensuses hold. It really feels like a show-me story.
It is absolutely a show-me story. The market is saying, okay, Crown, you want to be a pure-play tower company. Prove you can actually grow revenue without fiber and without Dish. Until they do that, the stock is likely stuck in neutral.
Before we wrap up, I want to touch on one final thing. It came up in the Q&A of the earnings call, a question about software versus hardware. And I think this is the existential threat for the whole industry.
This is the risk that keeps tower executives up at night.
Because traditionally, if I'm AT&T and I buy new spectrum, I have to send a crew up a tower to hang a new box. That costs money. Crown gets a cut. But what if I can just download a software update?
And we are seeing more of this. It's called software-defined radios. In some cases, modern antennas can be reconfigured to handle new frequencies just by changing the code.
Like updating the OS on your phone instead of buying a new one?
Exactly. And if that becomes the norm,
The tower model breaks a little bit. If carriers can upgrade capacity without physically touching the tower, Crown doesn't get that extra rent.
so the pure play model is a bet on physics. It's a bet that we will always need more physical hardware to move data.
Crown is betting on physics. They're betting that as data consumption doubles and triples, software just won't be enough. You'll need more massive antennas, more weight. But if they're wrong,
If software starts eating hardware, then they have just pivoted their entire company into a box that is slowly shrinking.
that is a heavy thought to leave on. Crown Castle is betting the farm on steel and physics in a software world, all while fighting a $3.5 billion legal battle they might not even win.
It's going to be a very long, very interesting year for them.
A trough year indeed. We'll be watching to see if they can climb out of it. That does it for this deep dive into the messy reconstruction of Crown Castle. Thanks for listening to Griffonomics.
Stay curious.
See you next time.